All right, today we're diving into a financial forecast for 2026 that's, well, it's pretty wild. The report argues that two gigantic opposing forces are on a collision course. So today we're going to break down exactly what that means and why it matters. Let's get right into it. So the entire analysis hangs on this one big idea, the great bifurcation. You can think of it like two tectonic plates grinding against each other. On one side, you've got the incredible deflationary power of AI and new tech, which is working to make everything faster and cheaper. But on the other side, you have the inflationary force of a fragmenting world. We're talking new tariffs, messed up supply chains, all pushing prices up. The core argument here is that 2026 is the year these two forces finally collide, head on. Now, what makes this whole thing so potentially dangerous is something the report calls cyclical resonance. It's the idea that it's not just one thing happening, but that multiple massive historical cycles are all peaking at the exact same time. We're talking about a 54-year economic supercycle, the generative wave, aligning with shorter 11-year cycles of global conflict. It's literally a perfect storm that's been brewing for decades. So here's how we're going to break it all down. First, we'll look at the historical cycles creating this perfect storm. Then, we'll jump into the big AI debate. Is it a bubble or a true revolution? After that, we'll see the geopolitical forces pushing back, uncover a pretty scary systemic risk that's hiding in plain sight, and then wrap it all up with how to actually invest in this new era. Okay, let's kick things off with the foundation of this entire forecast. These deep, long-term cycles that are all coming together to set the stage for 2026. So this timeline basically shows that long 54-year wave in action. You see the super high interest rates back in the 1980s kicked off a long, multi-decade period of disinflation. But the big claim in this report is that that cycle is over, done. We are now in the early days of a brand new long-term inflationary cycle. And that's the key. The whole economic background has flipped from decades of cooling prices to a new era where prices are structurally set to rise. All right. Now, let's talk about that deflationary force that everybody is obsessed with, artificial intelligence. The huge question on everyone's mind is, are we just living through a repeat of the dot-com bust of 2000, or is this time really, truly different? So let's just ask it straight up. Is the AI boom a bubble? Well, the answer this report gives is fascinating. It basically says that, yeah, the sentiment out there feels pretty skeptical and fearful, which sounds like a bubble, but the fundamentals, the actual money, are telling a completely different story. And this chart just lays it out, crystal clear. Back in 2000, you had startups with zero revenue just burning cash on Super Bowl ads. Today, the leaders are these giant global hyperscalers, your Amazons, Googles, Microsofts, and they are generating just insane amounts of free cash flow. And here's the kicker. They're spending it on real physical stuff, chips, data centers, power grids. It's kind of ironic, but the report says that all the skepticism we see today is actually a sign that we aren't in a classic bubble, which is usually driven by nothing but pure euphoria. And the sheer scale of this physical build-out is just mind-boggling. This number $1 trillion, that's the forecast for the global semiconductor market for 2026 alone. This isn't some virtual trend. It's a full-blown industrial revolution happening in physical reality. And this right here shows you that the AI race has moved past software. It is now a war for physical resources. Energy demand is so high that one company is planning a massive data center in Greenland just so it can use glacial meltwater for power. And check this out. Here's the key bottleneck. The whole industry is pivoting to make these advanced AI chips, and that is directly causing shortages of the standard memory that goes into our phones and laptops. It's all connected. Okay, let's switch gears and look at the other side of this whole thing. While AI is pushing for a more efficient world, there's this powerful counterforce pushing in the exact opposite direction: geopolitical fragmentation. So this is it, right here. This is the great bifurcation in a nutshell. On one side, you have AI, a massive deflationary force. On the other, you have geopolitics, an equally massive inflationary force, just throwing sand in the gears of the global economy with tariffs and supply chain chaos. And the market is caught right in the middle of this giant tug-of-war. And the report points to the new trade war as the main engine of this geopolitical inflation. A 10% universal tariff is already jacking up costs, and there are threats it could go as high as 25%. Now, for a company, this isn't just some headline, it's a logistical nightmare that forces them to rethink where they build everything. And you can bet those costs are going to get passed on to us. And you can see the real-world impact right here on this chart. The growth forecasts for the Eurozone in 2026 have been slashed because of this. And this is the classic recipe for stagflation. That's that toxic combination of rising prices and falling economic growth. It's basically the worst-case scenario for a central bank because it leaves them with absolutely no good options.
Okay, so while everyone's eyes are glued to AI stocks and geopolitical drama, this report points to a major risk that's been building up in a much quieter, less visible corner of the financial world.
So let's talk about something called the private credit market. What is it? Well, it's basically non-bank lenders giving loans to medium-sized companies. And fueled by years and years of rock-bottom interest rates, it has absolutely exploded into a $2 trillion monster, operating mostly in the shadows, away from the prying eyes of the public markets. So how on earth did it get so big? The report talks it up to a behavioral bias it calls swarm stupidity. You had a flood of investors, all desperate to earn some kind of return, who just piled into these private loans. And they made a really critical mistake. They mistook the absence of a daily price ticker for the absence of risk. But look, just because you don't see the price go up and down every day doesn't mean the risk has magically disappeared.
So here's the scary part, the chain reaction. This is how a problem in this one shadowy market could infect the entire financial system. Step 1. High interest rates cause some of these private loans to go bad. Step 2, the private funds that made the loans suddenly can't pay back their own loans from the banks. That's called solvency contagion. The risk spreads to the banking system. Step 3, investors get spooked. They rush for the exits, forcing the funds to sell assets at fire sale prices. That's liquidity contagion. And from there, it's a very short jump for that panic to spill over into the public bond markets and trigger a much wider crisis.
So after all that, with this incredibly complex picture of dueling forces and hidden dangers, where does the analysis say the smart money is actually going to flow? The strategy here is actually pretty simple. You lean into the bifurcation. So on one hand, you want to own the physical building blocks of the AI revolution, the infrastructure, the energy. On the other hand, you want to own the hard assets that do well in an inflationary world. And what do you avoid? The stuff caught in the crossfire, like that private credit market we just talked about, or those heavily indebted zombie companies that just can't survive without cheap money. It's really about picking your side in this economic tug of war. Now, among all the physical assets, the analysis really singles out silver, and this quote just perfectly sums up why. It's seen as this unique asset that sits right at the intersection of both of these massive global trends. It's absolutely essential for future tech, think solar panels, AI hardware, but it's also that traditional safe haven asset people run to during times of inflation and uncertainty. And this chart really shows you the big shift that's happened. Industrial demand, driven by things like solar and all kinds of electronics, now makes up a full half of all silver consumption. According to the report, this is creating a structural supply deficit. In plain English, that means demand is consistently higher than supply, which provides a really strong fundamental floor for the price, totally separate from its role as a monetary hedge. So look, if there's one core takeaway from this entire forecast, it's this. The simple, set it and forget it, 60-40 portfolio of the past, it might not be enough anymore. We are heading into a market that is defined by deep, powerful, and conflicting themes. And navigating it, according to this report, is going to require making active, conscious choices between the deflationary world of tech and the inflationary world of geopolitics. And that really leaves us with one final thought. In a world that's being pulled in two completely opposite directions, where are you going to find your anchor?